Hello, I hope you can hear me. You are welcome as we look into our entry model part 2. The part 2 is the moving average, and for this we are going to be using the 21 moving average simple, or you can say simple moving average. Okay, so you can easily put that on your trading view. You see it over here. That's SMA 21. This is the setting. Let me go to the setting. When you come to this part of your trading view, this part, that place FS, you click on it. Then you can search for moving average. Moving. When you just click on moving, you will see the moving average there. Okay. Then you can also highlight it to make it to be in the favorite section, as I've done. Then when you activate it, click on it, it will pop on your screen. Then just come to this part, this top part of your trading view. Click on that setting icon there. Click on it. Then it will display like this. You can change the color. Click on this part to change the color to black and the thickness. So when you click on it, you change the color to black. Then the thickness, you use this second thickness. All right. Then let's go to the input section. Click on the input. When you click on the input, you change the value to 21. Okay, so the value will be in 21. After doing that, you just click on OK. That is all for the moving average setting. So we want to understand how we have to use it. As a reminder that we are just focusing on three major candlesticks. Three major candlesticks, that is our major focus when we are making our entry modules. And what are the three major candlesticks? The first one, we have body. It will have wick up and down here. Then we have second one, the second candlestick that we have wick and body up and down also, and then the third candlestick. All right, now we want the number 2 candlestick wick to be the longest among these three candlesticks. 1, 2, 3. So the number 2 candlestick will be the longest. I've explained that in previous video. Then in this video, I want to bring our attention to what we call FEG, or fair value gap. Okay, I have explained this on my videos on YouTube. Please go and watch the video about that block. I will pull it up here so that you watch it, understand what we call FEG. But simple understanding of it is this. Now, when we have this candlestick 1, 2, and 3, then we know that candlestick 3 body has to close below the low point of candlestick 2. Okay, as we have explained before. Now, how do we know that this particular signal is not already activated? Because if the signal is already activated, there's no need of you waiting for price to come to that place again. It is when price now produce the number 4 candlestick. So at the close of the number 4 candlestick, it can tell us if the price has been mitigated or it has not been mitigated. Now, what can happen is when the wick and the body of number 4 the 4th candlestick did not touch this our entry. Okay, it did not touch this our number 2 candlestick. It did not touch it, because what we want is when price make downward move, up, down, downward, then probably when the entry is here, we want price to come back to the entry and tag us along to sell. Okay, but in this situation, price has formed our number 1 candlestick, number 2 candlestick, number 3 candlestick. Our signal is now valid, is correct, but maybe at the time you come to meet the trade, number 4 candlestick is already forming, or it has already formed. Okay, because when you just see, maybe by the time you come to meet the trade, the number 1 candlestick, number 2 and 3 candlestick, they are already formed. You can just enter this trade accordingly. That is our signal. But our signal, when it is already activated, is when there's some time when you come to meet the signal, number 4 candlestick, we have already extended its wick or body into the range of this number 2 candlestick, and by this signal is already activated. So you trying to sell again after this signal has already been activated, probably this price is going downward, is of no use, it's not good. If price come back to that place after price has gone some distance, this trade might be a loss because you do not understand what we call fair value gap. Now you can see after the fourth candle has been formed, between the low point of candlestick 2 and the high point of candlestick 4, we can see a space in between. By the time you draw the low point of candlestick 2, you draw it across the body of candlestick 3. Then the high point of candlestick 4, you draw it to your right hand side. In between this, you can see there's a gap. That gap is called fair value gap. It's an indication that yes, this particular signal has not been tapped. Okay, then we can enter the signal. How can we enter it? This is the illustration. Now the signal is there. 1, 2, 3. Our signal has been available. Number 4 candlestick has formed. It did not tap into our signal. Then we'll now see the fifth candlestick has formed. Then it tap into it with a wick, and by so doing, this signal is now active, already activated. Then we can wait for our signal to play out. I will show you some example, but let's continue. So this is a pictorial representation of how you can spot this on the real life chart. I'm using all the illustration for downtrend. That's what I'm using to make this explanation. Downtrend, impulsive move, retracement. Then we have impulsive move again. And what happened here is when price was making this retracement, price tapped into the 21 moving average. All right. When price tapped onto the 21 moving average, it now gave us our signal. Price gave us signal. Then in this place, price came back again to cause a flip. You know what I mean by a flip? Downward movement, upward movement. Automatically, this is now support. So price is supposed to come to this support and continue to buy. But in this situation, price is just cause down movement, upward movement, support. But price came to the support and take it out. And you know what happened during a flip? When price has taken out the support, automatically the support is now resistance. But in this situation, we have at this 21 moving average, simple moving average, we have that our signal is already there. So what we want to do is to expect price to come to this our signal and activate our trade and take us along with it. Okay, that is because second scenario that might happen in a downtrend, moving upward, and then tap on the 21 moving average. Then as such, price give us our signal there, but immediately after the signal, price just tap on this signal that it has been provided, and then use another candle wick or body to tap on it, and just continue to sell. And you know that the support is already here, but before price go to the support point, the signal has already been activated, and then we are selling or buying. If it is for uptrend, we are buying. But all the scenario here, they are for downtrend. This brings us back to this picture illustration. Okay, the first scenario is when price make they pull back and then break the low point, then it will not come back and tap on it. Okay, while the second scenario is when price make this signal, instantly price will come to tap on the signal and then continue to sell accordingly. Okay, this is the main mapping out as you most likely see on the real chart. Okay, this is 21 moving average. This is a downtrend, and when price is forming a downtrend, automatically it tap onto the 21 moving average. After that, you can see that the wick of the number one candlestick and number 3 candlestick, they are below the wick of the number 2 candlestick, and as such, the entire body of the entire candlestick of number 2 is now a signal. And you see that when price just gave us the signal here, price came to form a flip first before it now went back into the signal and tap along with it and continue to sell. Okay, that is for entry after flip. But of entry before flip, whereby we have our downtrend, we have our uptrend. Price gave us a signal at 21 moving average. Okay, then not long before price came to this, because automatically when price tap on the 21 moving average, then this point here is now our what, our support level. But before price came to the support level to come and probably take it out, after our signal, price came and tapped into it and then continued to give us our trade, and this gave us a perfect trade. I hope that is understanding. Now let's go and check some examples on the real chart. Now, as an example, I want to show you this because this is not a perfect signal, but it's a good signal, and I will explain it. Now, looking from the left hand side, price was having bullish movement. Automatically, this is our low, this is our high, and then price is retracing back down. And while price is making those retracements, it was forming minor pullback, up, down, up, down, up, down, just like that. Then let me zoom in now. While price was forming that different minor pullback coming back down, you can see this week low point, the other one high point, then this one was the low point, then the other one went up, high point. Then after the break off, after the resistance now is after the support now, this low point, and then that's the high point. This resistance support is now turned to resistance. Now see what happened here. If you count the candlestick, this is what happened. Price turned this support to resistance. Then this is candlestick 1, this is candlestick 2, and this is candlestick 3. And what is our rules and principle? That this is the number 2 candlestick that tap on this our 21 moving average. That is 21 moving average. Then we look to the left. The closest candlestick after the number 2 candlestick has touched it, the closest candlestick is this one, right? Now look at the wick. The wick is below the wick of the number 2 candlestick. Then we look to our right. Look at the number 3 candlestick. The wick is below the number 2 wick. Then the last condition for that is that number 3 candlestick, the complete body must close below the body of the number 3 candlestick, must close below the body of the number 2 candlestick that touch this 21 moving average. Okay, you can see that this is going to be, when you are advancing it, this is somehow not clear to you right now, but as time goes on, it's just the same logic. But market is very cunning to not just give you everything on platter of gold. This candlestick, this number 2 candlestick, this number 1 candlestick is somehow different from the regular candlestick you have been seeing. Then this number 2 candlestick is also different. This number 3 candlestick is somehow resemble the other candlestick patterns. Let me remove it so you see what I'm saying. So with this is automatically our candlestick 1, candlestick 2, candlestick 3. Then you can see what happened. Candlestick 4 automatically just tap along the trade, and by so doing, I put my set trade there, and then with my stop loss at the up, automatically this trade is automatically activated, and with 1 to 3 risks to the reward, this was a very successful trade. Now let's go to another example. So let's look at another example. Here you can see what price was doing from the left hand side, up, down, up, making series of pullback, and all those things. Then when price tap on the 21 moving average, let me zoom in very well so you see it. Price tap on it with a wick. You see that there's a wick close above the 21 moving average, confirming that yes, this signal is a good one. After that, we cannot begin to analyze if this is a signal we can take. Now the number 1 candlestick, you can see the wick is below the wick that tap into the 21 moving average. Then looking at number 3 candlestick, you can see the wick is also below the number 2 candlestick wick. You can see it very well. Let me remove this. Okay, let me remove this also. I hope you cannot see it. Number one candlestick week, number two candlestick week, number three candlestick week. Meaning our first criteria has been met. Then second criteria is when the body of the number three candlestick now close below the low, the whole entire low of the number two candlestick week, and that is what happened here. And you can see with this, it was a very good trade because after 1, 2, 3 candlestick wick closed below number two, and then the next candlestick that formed was what gave us this our signal to enter. So we are going to use the number two as our entry point, number two candlestick as our entry. That was what happened there. I hope you cannot see it. There are a lot of numerous examples you can see. As time goes on with the chart, you begin to see more and more of those. I'm just trying to explain that the techniques is that you don't have to cram how big the candlestick will be, or the type, the shape, all those things. One thing you have to note very clearly is when a particular candlestick use its wick to touch the 21 moving average and it closed below it, probably this is a selling market. What you have to do next is to check from your left hand side and see if the candlestick close to the one that actually gave this signal is below. So you can see it, this candlestick one is below this, then the following candlestick the wick also must be below the other one. That is the first criteria. Then the number three candlestick, the body must close below this signal. All this I'm showing is for selling opportunity. So this is for a downtrend, and you see it was a beautiful trade. Okay, that is all about how to use the moving average, 21 moving average with our price action. Please watch this over and over again, understand it, learn it, check on your charts. You will see it happening over and over again. Have a great time.